From the Magnificent 7 down to the Super 6, then the Fantastic 4, there's now just one stock to rule them all. That's right, the sole source? NVIDIA. And this is not necessarily a bad or bearish thing, but you do have to understand the dynamics that's there when trading the broad market indexes. So let's take a look through the data points and build a logical game plan for the end of this week. As always, check out the links listed down below in the description, hit the thumbs up button, and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. We'll kick things off with a closer look at the SPY daily time frame chart. What do we see here from a trend point of view? Certainly lows, higher lows, consecutive higher lows. And on the Monday and Tuesday session, we have soft higher lows because we never flipped into an hourly downtrend. Along the way, we have highs, higher highs with the Friday breakout of last week, and today we've produced a brand new all-time high, and thus the highest high in the trend sequence, and therefore, we know that the daily time frame chart can afford to pull back and search for a higher low without jeopardizing the uptrend that we've just outlined. So there are really 3 places on this daily time frame chart where I would imagine the buyers retain total control. The first place is just bullish consolidation up and over the Friday high in today's opening print at 496. From there, looking for something like a 2-day high breakout, 3-day high breakout to potentially kick things off for trend continuation early on next week. The next place to think about is a gap fill reversal off of the Monday and Tuesday highs at 494.30. That would be beautiful, repairing the structure and maintaining the trend. The next place would be a higher low off of 491.50 for another attempt at that level. And we're still willing to give the buyers the benefit of the doubt, even though we've already tested it early on the Monday and Tuesday session, because we're pulling back from the highest high. If we were pulling back from an equal high or even worse, a lower high, not the same interaction. But because we have the higher high, and it's very likely pulling back from this all-time high, we would flip into an hourly downtrend to travel that distance, we are looking for buyers to step up at 491.50 to cement a firm higher low. Now, there's nothing saying buyers have to step up at that level, but considering the strength of the daily trend, we're trying to trade in the direction of the prevailing winds, and therefore the higher low would be top of mind. If we slip that and make a move all the way down here towards equal lows around 488.25, when I say equal lows, we're talking about in reference to Friday's breakout of last week, the threat then becomes some sort of head and shoulders on the daily time frame chart after a lower high is produced. It's very speculative as of right now, and it really leads to the next question. Is there any stronger evidence on this daily time frame chart that strong sellers are stepping up and entering this market? And the answer to me is absolutely not. Strike number 1 for the sellers is today's gap up, right? This morning we open on a gap up. You can see in the lower wick, we look into the gap and then are able to close near the all-time high, the highest high of today's trend sequence intraday. We'll see it on the hourly in just a moment. So if stronger sellers were here, they should technically close an area of thin structure with no issue and be fighting for price acceptance inside of the previous day's range. It simply didn't take place on today's session, and therefore, I don't see a reason to believe stronger sellers are showing up. Reason number 2, strike number 2, if you will, all boils back down to what happened on Monday. You can see that in the lower wick of the hammer candle, we moved underneath the prior pivot top. And what saved the day? It was the one stock to rule them all. NVIDIA, as it reversed in a V-shaped recovery off of the morning lows, in my opinion, is really what allowed the S&P to close above 491.50. And then from there, what's the following sequence? On Tuesday, NVIDIA sells off. It's actually down 2.5%, right? But where's the bullish rotation? If you were watching on Tuesday, Tesla was up roughly 4.5%. So that rotation keeps the market sideways here. On the bar-to-bar count, we find ourselves a higher low and flat highs. If stronger sellers are here, this hallmark sign of uptrends would not take place, where we turn prior resistance into newfound support at the lows of Monday and the Tuesday session. So I'm not seeing any evidence of stronger sellers stepping up, but I would want you to be aware that risk-reward-wise, it can be very difficult to buy in to the highest high in a trend sequence. So intraday, if we do see continuation in the upward direction, we're really relying on higher lows over upward sloping VWAPs, opening ranges that break out that we can manage risk against, because on the daily chart, chasing this higher high, it's a little bit scary, right? As we know, if there is any signs of weakness across the Magnificent 7, or as we'll just refer to it from here on out, the core list of companies, right? If there's any weakness there and you're not seeing rotation, so if you're seeing NVIDIA sell off and Tesla, Meta, Microsoft, Apple are not picking up the slack, it's going to be a sea of red. And the reasoning behind that really comes from the market breadth. We're going to skip around a little bit in today's episode and go directly to the market internals. If you're not familiar with the screen, check out the video tutorial in the top right-hand corner. We really want to focus on today's session when we saw that breakout and the gap and go. Did the breadth look good or really more neutral? I don't know about you, but this looked incredibly neutral, closing quite literally near the zero line. The breadth readings, or at least the volume flows on the week so far, are not all that impressive, negative 65 million. So not substantial outflows, but as we're getting a break in the upward direction, we would at least expect positive inflows, not the case on the week thus far. If we look at the advanced decline line, you'll notice that we're tangled up around the zero line, not in trend higher zone as the market is gapping and going in the upward direction. And last but not least, the cumulative tick. It's certainly positive, but what do we know is a substantial read? Generally speaking, we're looking for 5,000, be it net negative or positive. In the case of a breakout, we want it to be positive. Are we anywhere close? No. I mean, we hardly scratched at positive 1,500 into today's close, as the market's giving us a gap and go. So breadth-wise, really not all that great. And on the Monday session, when we get that V-shaped recovery from NVIDIA, what was the exchange level data telling us? Strong volume outflows on that day, in-trend lower zone on that day, and not a terrible cumulative build in the downward direction, but certainly more bearish than bullish. Tuesday was completely sideways, really just consolidation, so we'll give some credit where credit is due. Buyers, decent job on the volume flows, close to trend higher zone, but really not much to show for in the cumulative build out of the ticks, certainly not even close to what we had at today's peak. So there's no really reason to believe at the exchange level there's mass participation outside of the core list of companies. So going back to the SPY Daily, if we don't see any green across the core list of companies, it could be a day of reckoning for the S&P. But I'm not willing to bet on that until the trend actually changes here near the all-time highs. As long as this rotation is taking place, again, they're selling NVIDIA, but they're buying Tesla, they're buying Microsoft. As long as that rotation is in force, I'm not going to try to step in front of a moving freight train, no matter what the market internals are suggesting. But when the day of reckoning comes around the corner, and it will come at some point, where it's sell everything tech oriented, yeah, it's going to lead to a nasty pullback in the S&P, and we'll trade it short on that particular day. It's like, at this point, it's less so about the sector rotation, and it's more so about the core list of companies rotation. Let's drop it on down to the hourly time frame chart and see what other nuances we can pick up here. In terms of trend on the hourly, it's certainly up, and you can clearly see that lower wick now, giving us a partial gap fill reversal, and all of the consolidation is taking place near the high. So the trend remains up. We have ourselves an hourly high or low from here to here. We have ourselves a high, a higher high. This is that beautiful bullish consolidation we talked about on the daily, up and over 496. You can see that the gap fill reversal keeps us outside of this balance. This is demand underneath us that would continue to step up. But what is one possible threat here? And this ties directly into the market profile. The threat would be if we do move underneath 496, this is more soon going to turn into overhead supply. And it's one of the concepts we've been talking about here around the channel recently, where the value area lows, like take for example, on the Tuesday session as we're balancing, right? The value area is technically low in the individual profile, so it would really require a full breakdown underneath these lows before these folks turn into overhead supply. The danger with today's session is that the value area and the point of control are slammed towards the highs of the profile. So now, all of a sudden, as soon as we start taking out Friday's high, today's low of day, I would have to imagine that the gap close becomes more likely because you have overhead supply weighing on price in the downward direction. So I'm very attentive in the ES, that would be, to like 49.95, and in the SPY cash, if we just head back on over here, this level, right, 496. If we're underneath that, I do believe a short-term pullback could ensue, but we know that as long as this is not Armageddon, as long as there's not a solid sell-off across all of the core list of companies, then we're looking for higher lows off of 494.30, or we're looking for higher lows once again off of 491.50. Let's take out the intraday anchored view apps and see what else we can learn from a confluence point of view. And what you'll see from the Monday anchored view app is that we have great confluence off the gap fill reversal. So top of mind here, higher low off of 494.30. Beyond that, notice how over time, as we move into the end of this week, these will slowly, this is coming from the Monday breakout of last week, as well as the sort of, what are we looking at here? We're looking at this anchor to the Thursday recovery effort off of the lows after Jerome Powell, or even the Wednesday Jerome Powell anchored view app, right? These will slowly provide confluence at that key line in the sand we just described at 491.50. So as long as you're getting a mixed bag in the core list of companies, all of these pullback levels are top of mind because the market structure remains bullish. There's nothing here suggestive of stronger sellers getting involved, but we're very wary of the breakdown under 496 because of the potential overhead supply we just saw in the market profile. Let's play out a hypothetical here just to further understand what's already taken place in the market and how today could have substantially changed the tone for the sellers. If we did see a full gap close and price acceptance inside of Tuesday's range here on today's session, now all of a sudden on the hourly time frame chart we have a double top, and then underneath the neckline here at 491.50, it's not game over, but it's certainly more dangerous on the daily time frame, flipping into a neutral trend. And that would be the example of not trusting 491.50 if we were coming from an equal high instead of today's higher high. So as you can see, we're trying to align with the prevailing winds. The market does still remain bullish here, but we're very, very cognizant of the rotations taking place right now in the Magnificent Seven and the core list of companies. As we move into the QQQ, we're just going to realize the same thing as the spiders, but magnified. We are on the daily time frame chart to kick things off. What do we see here from a trend point of view? We've certainly got ourselves those consecutive higher lows and maybe soft higher lows on the Monday and Tuesday session. However, today's high, the new breakout, is very important for trend continuation because prior to this, we had highs, higher highs, equal highs on Friday's breakout, and then the Monday and Tuesday session were inside bars, technically underneath and still equal highs from way back over here at 429.15. So today's higher high marks trend continuation, and it means we can afford a higher low on the daily time frame chart without jeopardizing the uptrend that we've now cemented. So ideally, obviously consolidation wants to happen over that 429.15 breakout point. We're looking for consolidation and then continuation in the upward direction. And if we do start to slip underneath 429.15, a stronger pattern for the shorts actually emerges in the NASDAQ compared to the S&P. Now, it's not we're looking for NASDAQ to go to zero, we're not looking for 400, we're not looking for 350, but on a look above and fail. So price acceptance back down underneath 429.15, the breakout point, the three equal highs from Friday, Monday, Tuesday. Now we can start to say the look above and fail should target the bottom end of the original range. The original range referring to the 5 days over here and the low of Friday's session from last week. That target would be at 423.50. Now, because we have ourselves the higher high on today's session, I wouldn't throw in the towel, and it's still very possible that you go lows, higher lows, higher lows, and you can look for a higher low here because we are pulling back from the highest high in the trend count. However, as we mentioned, the caveat is that shorts are available for that range rotation. And of course, we would have to see the evidence. I want to be very clear that we're not just blindly buying this long at 423.50. We would need to see the evidence that buyers step up at that level, and this is not something more sinister, possibly looking like a higher high double top, where now all of a sudden this neckline is in jeopardy much sooner than any structure we have in the S&P 500. And as we know, and this will continue to be the theme of today's video, if we're getting rotation across the core list of companies and money is flowing maybe out of NVIDIA, but into Apple, into Microsoft, this is not a strong short. If everything is red from the open, absolutely, we will have our day of reckoning in the QQQ NASDAQ 100. If we take a look at what's happening from an internals perspective, the breadth today was horrendous as we were finally making that new all-time high and breaking out of the range. We were at parity by the time the day closed. In terms of net flows on the week, we have negative 15 million. Just as a reminder, your substantial reads are either going to be positive 600 million or negative 600 million, not even close, as we're breaking out of a multi-day balance, right? As you can see in the advanced decline line, even worse than what we had on the S&P. Instead of being tangled at the zero line, we're firmly under the zero line, negative 648 million into today's close. I would give a little bit of credit for this recovery effort happening here, but certainly not supportive of the breakout that we saw, which again just speaks to the concentration risk in the core list of companies. But as long as that rotation is taking place, you really shouldn't be trading based on the internals. That's what the market has told us over the last little bit. It's going to require a red core list of companies paired with red internals. So at the exchange level, the underpinnings of the market are not supportive of this breakout, right? That's when you get your larger day to the downside. You can see an even worse cumulative build on the NASDAQ compared to the S&P, closing flat, 126 positive. Not 126,000, not 1.2 thousand, right? 126. Really, really weak read. Now, let's take a look at Monday. Monday is the V-shaped recovery from NVIDIA's morning lows. And this is basically a mirror image of NVIDIA. We'll take a look at that chart in just a moment. Look at the internals on Monday. Is this at all supportive of the reversal to the magnitude that we saw? Absolutely not. Big negative build on the cumulative tick, much closer to negative 5,000. There you have it, negative 6,000 almost on the close of the cumulative tick out of the NASDAQ on Monday. Certainly not a strong read at the exchange level. We're getting volume outflows on Monday. We're well oversold on the advanced decline line, right? So the day of reckoning can come, but you need to wait for the rotation out of the core list of companies and into more defensive stocks. And I would argue that's where you'll really see the S&P sectors play a stronger role. You'll see the XLK really take a back seat. And by back seat, we're not talking about the bottom of the list in terms of green names. We're talking about red. Right? So that's the larger breakdown out of the QQQ. But if we ask ourselves the question, are stronger sellers emerging here? The answer is still no. If we take a look at the hourly time frame chart, this actually does a great job of describing it. Notice on the Tuesday session, let's get a little forensic here. Tuesday session finds consolidation on the lows underneath a very key level. It's the pullback low from the Friday session of last week, and it's underneath the afternoon consolidation of Monday. So if Monday's afternoon buyers are going to act as overhead supply, if Tuesday's weak consolidation on the lows, it would seem as though the sellers have the upper hand. And this morning's gap up is truly a gift to the buyers because now all of a sudden, this is breaking out as a bull flag. You can see the gap fill reversal, and you can see the consolidation at the highs. So there's no evidence of stronger sellers. But in the rearview mirror, you can see that the sellers were building a very minor edge as NVIDIA actually sold off on that Tuesday session. Main reason is that Tesla is not nearly as heavy weighted anymore as your NVIDIA market cap. So there was the opportunity, but the sellers have failed, and it continues to illustrate that you don't want to be shorting this market as we remain in bullish structure, even though it's only a handful of companies that are driving the return in the upward direction. And to further the idea, we can take a look at the market profile. And by the way, if you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Look at the A period single prints on the Tuesday session, right? This, of course, represents thin structure. Volume at price is incredibly minor. And look at today's open. We opened on a gap up, right? A very, very minor gap up right near the prior highs of day. We looked into the A period single prints, and in theory, this is thin structure, right? So the market should have no issue rotating all the way back down to 17,660. Did we get there? The answer is no, and we do have ourselves a close back above the top of the balance range here, the three equal highs. You can see the value area and the point of control migrated higher with price. We have a decent excess high, so there's no indication of stronger sellers. Now, just like the S&P, we have to caveat that it will now be easier for the market to turn these folks into overhead supply, but I'm not seeing the evidence of stronger sellers. To really go short in the NASDAQ side of things, I would want to see the look above and fail complete with some sort of lower high back within, this as a balance range. In the NQ futures, you're really looking at the highs around 17,775, that's a mouthful, and then back on over to the QQQ cash, we're looking for the lower highs on the hourly time frame chart underneath 429.15 if a stronger breakdown is going to unfold. But as we've thoroughly explored by now, there is no stronger evidence of solid sellers. For now, I would be thinking about consolidation, continuation, flat high breaks up and over today's high of day, over 432, the flat number, looking for upside, right? We're trying to align with the overall trend, which remains in the upward direction. And then lastly, certainly last but not least, we've got ourselves the pie in the sky inverted head and shoulders. Just to take a quick measured move from that pattern, right? We're coming from the head of the pattern to the neckline, and we're stacking that on the neckline walking forward. That would suggest something closer to 438 through the upper edge of this week's expected move. Let's finish up the broad market with the IWM Russell 2000 and the small caps on a daily time frame chart. And really, this is a great synopsis of the concentration risk we've already harped on in today's video in the core list of companies. The Russell 2000 being a broader representation of US listed companies, you can see is in a weekly potential downtrend right around the corner. Weekly lower highs in store, we're looking for an equal low, and certainly a daily downtrend, right? If this is your high, you're building lower highs. If these are your lows, you're building lower lows. So daily downtrend in this segment right here is really not convincing when we have S&P and NASDAQ uptrends. If we're thinking about what's happening here, the daily inverted head and shoulders has failed. The right shoulder is now acting as overhead supply. And the bottom end of that range is exactly what rejected on the Tuesday session and exactly what rejected on today's Wednesday session. Now, I will give credit where credit is due. And on the bar-to-bar count, we do have consecutive higher lows as well as higher highs. So the buyers are trying to make something happen here. However, for me to really be on board with the broad market gaining strength via sort of diversification and the IWM acting as a representation thereof, I would really want to see the higher low over that level right there at 194.10. That's your key line in the sand on the daily time frame chart. If we reject here more meaningfully for just that lower high we just discussed, so here's a high, here's a lower high, and if we trade back down into the equal lows here on the weekly time frame chart, 187.75, we know that the risk becomes this is suddenly a double top on the weekly chart through the neckline, and you can kiss this thing goodbye, certainly going to act as a drag on the broad market, not a tailwind, supporting the new all-time highs we've seen in the NASDAQ and the S&P. Let's move on down to the hourly time frame chart just to get a little bit more granular. Just want to reinforce the idea with the recovery effort on the Thursday session of last week, on the Friday session of last week. None of those have really amounted to much. And you can see on today's session, we open up, form this big hourly hammer candle, and into the afternoon, we make an equal high, but we fade directly off of that equal high. So as a matter of fact, on the hourly charts, if the trend is going to more meaningfully continue in the downward direction on the daily, I would say this turning into a double top, touch 1, touch 2, breaking underneath this neckline at 192.85, that's where we'll know more definitively, okay, it's game over in the IWM. This is certainly not going to help, again, as a tailwind for the broad market making those new all-time highs in the S&P and the NASDAQ. And if we take a look at the market internals for the IWM, the Russell side of things, it's the same story. We really didn't see anything impressive volume flow-wise on today's session. The advanced decliner was underneath the zero line. The cumulative build tried to get in gear on that afternoon rally, but right into the close, we find ourselves back at zero. Again, some credit where credit is due on the Monday recovery effort. We get to neutral. On Tuesday, it's not the end of the world style read in the cumulative build, but as we're trying to make a move in the upward direction, and this is a much more important move for the IWM based on what's at stake here, right? The weekly higher low, the daily trend based on the inverted head and shoulders flipping. To me, those internals being neutral are not enough as the market's trying to grind in the upward direction to give the buyers the benefit of the doubt, and we can see the risk that this poses to the market as a whole. So just to sum things up on the small caps, unless we're really getting price acceptance, unless we're really getting higher lows over 194.10, this is going to act as a headwind to the market. Now let's flip this script, and let's say what if? If the IWM actually does get acceptance up here, which the internals and trend itself, price action itself, are not overly supportive of, but if that's the case into the end of this week, then I suppose it might, not by a long shot, but maybe just a little bit, dampen some of the blow if we see all of the core list of companies in the red. Again, by dampen the blow, I'm talking about maybe instead of a move that's negative 3%, we're talking about negative 2% in the S&P and the NASDAQ, right? We're not talking about saving the day, seeing a green day in the S&P just because the IWM is green, especially if the core list of companies is red, right? So that's the takeaway here from an intermarket dynamic perspective. Let's finish it up with our market profile for the Russell. And you can see that the value area is trying to migrate in the upward direction today, overlapping to up. We have this very mechanical high at today's high of day. And also, if you extend this off to the left, it's almost on par with the point of control over here. We know it's also that 194.10 level in the IWM cash market. In the futures, we're using 1970. If we can clear 1970, maybe that's helpful. But as of right now, there's nothing overly suggestive that we have stronger buyers. The last takeaway on the market profile is just looking at the single prints in A period from the Tuesday session, and it's the same takeaway as the NASDAQ, right? You can see that we looked into it today, found buyers, and tried to recover higher. But as we just saw on the price action chart, we actually closed weaker, much closer to that area. So if we fall underneath that 192.85, looking for lower, that's a nail in the coffin for the market. If we go back on over to the market profile, any price acceptance in the Russell futures underneath 1950, we'll call it for round numbers sake, underneath 1950, these folks are overhead supply, and we're going to have a headwind for the broad market, not a tailwind. Let's get granular and take a look at the weekly performance of our S&P sectors. Leading the pack here is the XLB materials sector, up 2.18%. It's It's really not what you want to see. This is an extremely lightweight sector. It's the lightest weight sector in the S&P, so it's not helping drive the gain here. And instead, you can start to see that the SMH semiconductors, not a direct sector of the S&P, is really pulling the weight in the upward direction, up 1.6% on the week. Underneath is industrials. Not a bad look here. It's certainly more of a risk-on style sector, but it's not a heavyweight risk-on sector, and it certainly doesn't fall into the technology category. The XLY is outperforming based on Tesla's return, so far, towards the top of the list, we've got a little bit more of a mixed bag, not the end of the world, but not beautiful if we're looking at new all-time highs. And this should not come as a surprise considering all of the conversations, again, that we've had so far with the concentration risks in the core list of companies. At the bottom end of the barrel, it's the XLU utility sector, down 0.69%. It's the XLC communications, down 0.64%. And then the consumer staples sector, down 0.51%. It's actually lovely to see the XLU utilities down there as we're making a new all-time high. XLP, same concept. Would love to see these lighter weight risk-off sectors at the bottom end of the barrel. The head scratcher, of course, is the XLC. What are communications doing at the bottom of the list as we're trying to see a healthy rotation here? Specifically, like the metaverse, for example, today, up 2.5%. Yet the communications sector is still red on the week, so it starts to reveal some of the cracks in the armor based on the posture that we're seeing. Let's check in on the structural charts and just evaluate what's happening from this point of view. Nothing really concerning out of the XLB. So remember, it's a lightweight sector, but upward pressure is still upward pressure, just not ideal as it's leading the pack to a new all-time high in the S&P. So no concerns with this chart, but just not helpful posture-wise. SMH definitely looked pretty good here with a weekly higher low, look below and fail on this, breaking out, and now a 3-day balance. If we can really get some more price acceptance over 196 into blue sky territories, I could see the SMH acting as a positive catalyst to keep the S&P and the NASDAQ green on the week and prevent some of those days of reckoning where possibly the core list of companies are red. Obviously, if your SMH is going to be green, if it's going to be breaking out up and over this level here, it's very likely that NVIDIA has something to do with that. Today's session was brought to you by the TSM, Taiwan Semiconductor. That was a big mover on the semi side of things. So we're watching that closely. The larger threat in my eyes for the deeper pullback in the S&P and the NASDAQ is when and if the SMH takes this out as a possible double top. We're not there yet, and there is no indication of it on the daily time frame based on the price action, but we're just keeping it in our back pocket as a situation to understand what might be unfolding in the S&P and NASDAQ if there's a larger breakdown. Here's the XLI, new all-time highs. Nothing really bearish to say about this chart. Higher low pullbacks are welcome. Good to go. Next up, XLY, consumer discretionary. It's trying to get in gear, but we still don't have that firm break up and over 177.80. So although the rotation into Tesla was strong on that Tuesday session, Amazon's sort of lackluster performance, in my eyes, is preventing this from rotating up into the 182. If they pass the baton to Amazon, notice that I'm not going to call it a complete laggard, but in terms of 2.5% versus 62 basis points, a little bit of a laggard, right? If they're going to pass the baton, maybe Amazon has what it takes to get us to 182, and that would keep the rotation bullish, not only in the core list of companies, but it would also keep this propped up in terms of a risk-on sector towards the top of our weekly lineup. Continuing along to the XLV, new all-time highs were produced. So if there is going to be a risk-off sector leading the pack, we want it to be the XLV because, as we know, it's the second heaviest weighted sector by market cap. As we can see here, daily inverted hammer. If this does pull back, looking for a higher low, and that, of course, would maintain more of a bullish look for the second heaviest weighted sector by market cap. But as we know, it's more D for defensive. So the pullback here would be welcome. Straight up continuation as the S&P sits at all-time highs continues to raise some concerns about possible concentration risks and a deeper pullback unfolding when and if something like your SMH gets hit harder, when the XLY gets hit harder, right? When this sort of sees the day of reckoning, this is not what you want to see in terms of posture. XLV leading the pack in the upward direction. Let's take a look at the XLF. What's going on with financials? Stable inside of this sideways range up here. It's helpful. It's not breaking down, but it's certainly not adding upward pressure as long as we're underneath this pivot top. If we are going to see a more meaningful contribution from financials, you want to see the breakout of 39.50. Next up is the XLE energy sector, lighter weight, but as we know, certainly important from a global and economic expansion perspective. Sideways in this range does strike me as healthy, so long as we're not breaking down from 82.75, I think it's a positive contribution to the S&P. Real estate, really lightweight sector, even with the 10-year bond auction today and rates moving in the upward direction. You can see the rebound here off of 37.80 above the top of the previous range. Because of what Powell has already stated, that rates are likely not going to go any higher than they are, we might be cautious about when the first cut is ultimately coming in, but we're likely not going higher. I don't really see real estate making a stronger move underneath the bottom of this range, which is really where more trouble would be found. So 36.60 to me appears to be safe currently, but we'll keep a close eye on it, watching some of the more commercial side of the real estate market. Next up, XLK. Nothing really bearish to say about this chart. We do have a breakout here. Unlike the QQQ, it did not break out to a new all-time high. So actually, I would watch this for the S&P to say, if this is clearance of a pie in the sky inverted head and shoulders, if we can accept over 203.60, there's no reason to believe that we won't test the all-time high, and that of course is bullish pressure into the end of this week. If we fail back down underneath the neckline and chop around in here, we're neutral on the S&P, and falling underneath $200.65 starts to raise some larger concerns, just like the SMH. Maybe this starts to look more like a double top. Obviously, your neckline would be much lower, but this is a good first loss, if you're bearish, of the right shoulder of the pie in the sky inverted head and shoulders we just talked about, $200.65. So far, so good, but watching this stuff very closely, considering that we're basically moving on borrowed time. Next up is the XLU Utilities. Looks weak, looks like it's ready for a breakdown after consecutive lower highs coming into the equal low. This is not really screaming, risk off for the market to me. It's just like, hey, as rates continue to move in the upward direction because of Powell's commentary, we're going to chase short-term yield instead of yield from the utility sector and just avoid the risk of companies in the first place. Next up, XLC Communications. It's just a mild drift to the downside. So although it's down here at the bottom of the lineup, it's really not doing anything structurally that's concerning or even raising a red flag. Remember that as long as we're above this gap, that's like rainbows and butterflies. And even if we close the gap, there's an opportunity for a higher low over 76.95. Not concerned with the structural chart. Lastly, we've got the XLP, which is slowly creeping in the upward direction. We've got to give credit where credit is due. This is certainly turning into a daily bull flag. The trend is more meaningful here. It's definitely diverging from the utilities, which was fairly a mirror image until not so long ago. So is this starting to creep in as the first risk-off indication? I would argue yes, but we pay much closer attention to this on a relative basis to the XLY, and we'll see that on the specialized ratios right now. Here is that ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. The XLK continues to hold up over that upward sloping 50 SMA. It would be ideal if it could make a run for the equal high up here, but we know it's been taking a breather. Look at it in the lineup of our sectors down towards the bottom end of the list, only up 0.68%. So not acting as a risk-off indication, but we'll see if it can pick up the slack, and primarily you're looking for rotations into things like Apple and Microsoft to drive the return in the XLK as a sector. Healthcare is trying to perk up, trying to be constructive here, but not totally sold that this is a risk-off style look. XLF leaves a bit to be desired, right? We want to see it break out of that balance range if it's going to contribute more meaningfully to the S&P. And the XLY, it's trying to move in the upward direction, but as we saw, again, the same concept, it wants to break out of that balance range more meaningfully if it's going to contribute to the S&P moving in the upward direction. Communications are pulling back. Remember that this is a risk-on indication, and this is on the heels of the blowout numbers from Meta as we ended out last week, right? So far, so good. No issues out of the XLC. Risk off is not a threat with the lower high and rotation back down to the equal low out of consumer staples. And you can see a lower low here in utilities. Risk off is not a threat. Same thing with energy, not outperforming by a substantial degree, and real estate as a hard asset being defensive as well underneath a flat 50 SMA. So it leaves a little bit to be desired. We're not going to try to mask this up. This is not pretty, and we would like to see something better out of the XLY, but as long as the XLK maintains itself over the upward sloping 50 SMA, not the end of the world. Let's take a look at some of these specialized ratios. The first one is the XLK over the SHY. This continues to look more like risk on as opposed to risk off. We're going to jump over the XLK over the XLU because it's a mirror image. Here's the XLY over the XLP, which is the apples to apples comparison that we were just talking about on the XLP structural chart. Notice that we're moving back up and over that 2.38 mark. And of course, we want to see a recapture of the 50 SMA. SMA. To me, it's trying to hold on to that more meaningful look here for a weekly or even monthly at this point higher low, but it's got some more work to do. We're not out of the woods because, of course, the threat on the back end is that you just get a lower high if we can't clear that 50 SMA. So watching it closely, but trying to remain constructive on more of the risk-on indications based on what we're seeing in the structural charts themselves. I've got a new one for us to take a look at today, and it's the SMH over the XLV. So it's still a measure of risk-on via semiconductors versus risk-off via healthcare, but it's a different approach compared to what we're used to. And you can see that we've got a bullish look here with an opportunity certainly for a higher low. We're watching to see if we can get an equal high breakout. If we just consolidate sideways and then start to move lower, that would be a larger red flag that we would watch down here for some sort of pullback to start to emerge. It hasn't happened yet, but we're watching this new ratio very closely, SMH versus the XLV. Let's move along and take a look at our dollar. What do we see over here? Certainly a more meaningful breakout was taking place on the Monday session. You can see we've moved out of this range here, and that should act as a headwind for the market, yet the market moves higher. So if we're thinking about all of the risks that are compiling at the exchange level, at the foundational level of what the market, in theory, quote, should be doing, as the dollar's moving higher for a breakout really doesn't add up to a stronger move higher in equities, so we can really discern, again, the concentration risks in the core list of companies. I think everything really boils back down to that in today's episode. We can move along and take a look at gold, right? If the dollar is higher like that, gold must be lower. It's actually just neutral inside of its range over here, not really giving us a whole lot to go off of. So we could take a look at silver perhaps and see if silver is giving any stronger indications. Oops, we do not want the comma. There we go, or apostrophe rather. We are breaking down underneath this level. So does it make sense that the dollar is moving higher? The answer to me is absolutely. If the silver contract here continues to migrate underneath 2250, it would seemingly act as more of a headwind for equities down below based on the relationship with the dollar. So continuing to monitor that, but as we know right now, the only thing that really matters is the core list of companies, the Fantastic Seven, or the Fantastic Four, rather, I should say. Let's move along and take a look at interest rates because they do creep in the upward direction here. They're breaking to the upside off of some sort of equal low, but remember, this is not going to be a more meaningful double bottom. I will not be concerned in waving the red flag, hey, watch out for rates, until there's something over 43.33, right? And the reason that we know that is because that was the previous pivot top, and Jerome Powell has already committed that it's very likely we've reached the peak rate from the Fed. So I don't really see a world in which we would take this out in the 10-year unless there's a poor auction. And on today's session, we know that the 10-year bond auction actually went swimmingly. There was no issue with the ZN. We could take a look at this, and what you'll notice is it's just flat. I mean, it's certainly attempting to break down underneath this level here with some red momentum. That's why rates are slightly higher. But even if it breaks down to here for a retest of the inverted head and shoulders neckline, the ZN's, the more tradable instrument compared to the TNX. So maybe this resonates a little bit more. As long as we find a higher low over that, you're not going to get a break up and over 4.33%. In the 10-year yield. You're just not going to get it. So not concerned with rates substantially moving higher. If we need to change our tone, if there is some sort of Armageddon break, if there is a fundamental shift, we'll of course alert you. But as of right now, not really a threat for our broad market. I would tend to think that rates coming down over time will act as more of a tailwind or a justification for some of the move higher that we've already seen. Let's take a look at the inverted ZT to get a heads up on the Fed tracker tool. And what I'm going to start to tell you to monitor is basically more price acceptance over this 102, which is technically under because it's inverted, right? So if the 10-year starts, or excuse me, the inverted 2-year starts spending more time above, to me, that's an indication that it's very unlikely we're even going to get the May rate cut. It's already very likely that the March rate cut is off the table, something like 80% odds say, no way, Jose. But if this continues to spend more time or under, less, depending on the way you're looking at it, more time over the 102 level on the inverted chart here, very unlikely that that May cut comes in force. And as you know, if you were watching the 60-minute episode from Jerome Powell on Sunday evening, he actually mentioned, maybe it was a slip up, but he mentioned rate cuts are more likely going to happen in the midpoint of the year. If midpoint was very deliberately chosen, that of course would suggest the June timeframe, the 6th month of the year. Straight from the tracker tool itself, no big updates on the March timeframe meeting. That is to be expected, higher odds of a pause based on all of the commentary thus far. But the 60-minute segment on Sunday night is really, in my eyes, what drove the probability shift here on the May timeframe meeting. If you watch the Saturday update video, we had something like 6% odds of a pause in May. That has obviously increased to 36.6% odds of a pause in May. So the market's starting to come to grasp with, hey, we're very likely not going to get all 6 rate cuts that we were pricing into perfection. We're still at all-time highs. We're trying to justify that PE multiple expansion. Maybe earnings are going to play catch-up, but as of right now, we've already drifted back to 5 rate cuts. And if the market starts to realize that, hey, May is not going to be it either, it's very likely that the 4 rate cuts would have to imply some sort of price correction based on a fundamental valuation point of view for the S&P 500. And what might influence the May timeframe meeting is, of course, the initial claims that continue to come out on the jobless side of things every Thursday. Thursday at 8:30 tomorrow morning, live in the penthouse, we will take a look at the market's reaction to the initial claims. So far, the expectation is for 221,000, and as we know, that's well underneath our threshold of 250,000, where larger issues start to arise in the labor market. Now, I will mention to you, and this is something that we've been tracking for the last 2 weeks, we have some shots across the bow. Some warning flags have been raised. You'll notice that we missed expectations now for 2 weeks in a row in the upward direction. Is it something to really be concerned about? Not yet, because we're still underneath that threshold at 250, but I would be watching this closely. If the trend starts to shift here on the very immediate time frame, you could even draw in something like a resistance trend line, right? It's not a technical chart, but you get the gist. If we start breaking that, if we start spending more time, so to speak, quote, spending more time up here, it starts to look a little bit more dicey for that sort of market maintaining a bullish stance, right? And obviously, the Fed reacting and cutting rates prematurely, not based on their intended path, but trying to save the day, save the labor market, that would raise some red flags. Like, why the panic all of a sudden? Is the market much weaker than we would expect? And right, fundamentalists are probably screaming in the comment section, yes, of course it's weaker than we expect. This is all fugazi. I get it, but until the data actually flips, we're not going to implement that as a strategy to short the S&P, short the NASDAQ at all-time highs. Let's take a look at the earnings calendar. Of course, today after the close, we got ARM. We'll talk about it tomorrow morning in the pre-market prep once I can dive into the report there. We'll see if they have any comments about the open sourcing of the chip design and how that might affect or impact the AI mania we've seen thus far. Into the end of this week, nothing really notable. Some lower tier technology stocks, if you will. Expedia might be interesting from a consumer spending perspective. Same thing here with PepsiCo before the open on Friday. The market's appetite for risk is virtually unchanged from when we checked in over the weekend. The TLT ratio to the S&P is not signaling a flight to safety currently. If we take a look at bonds in relationship to themselves, small creeps in the upward direction, but overall in the context of possible lower highs on higher timeframes, and my thesis still remains that people are trying to lock in shorter term rates before the market starts pricing in when that first cut is ultimately coming from Jerome Powell. The cut doesn't need to happen, it just needs to be priced in a little bit more firmly, and then those short term yields will move in the downward direction. The reason I'm not concerned about the TLT, rolling over the way it is, or bonds in relationship to themselves, this has continued to be the thesis, is that credit spreads are not suggesting anything major. This is SVB, Silicon Valley Bank. When it blew up, you can see the uptick in credit spreads, uptick in credit spreads. Certainly not the case, even with what we see out of NYCB, just not really moving the needle from a risk management perspective in the credit market. If we take a look at the HYG high yield in relationship to equities down below, it remains divergent. And instead of now giving us that equal high, remember we had that versus the higher high over here, we were like, okay, this is not the end of the world. Maybe it leads to a pullback in the S&P. It was why we were very skeptical about upside continuation into the early stages of this week. Now we actually have a firm negative divergence where the HYG is yielding, no pun intended, a lower high, and the S&P is clearly offering a higher high. So overall, this would suggest everything we've discussed so far, that the concentration risk is paramount. As soon as the core list of companies see any bit of red sustained across all of them, this would not really suggest we have a firm footing underneath us to justify the breakout we've seen thus far. Let's move along and take a look at Bitcoin, the digital gold. It remains sideways in this as an overall range. We'll watch out for a possible breakout over 45,100 to sustain more of a risk-on opportunity for the market, but so far still contained within the range. And again, a very minor data point. Moving into some breadth indications at the New York Stock Exchange level, really. So similar to internals, but different to some degree. New highs versus lows on a week-over-week basis is really flat. It's not doing anything impressive. And once again, I would just remind you that if we look at the early stages of a market recovery effort, so here's the all-time high prior to the sickness, here it is after the sickness, we don't need those blockbuster reads. I'll continue to reinforce that idea as the market breadth looks horrendous intraday when we're looking at the internals themselves, when we're looking at volume flows over on the VOLD in the S&P 500, but market level, at least at the weekly time frame, not all that bad here with the sideways activity over the zero line. Let's continue to take a look through them. The SPX A200R is not breaking down aggressively. It's more so just sideways up here. So even though we're seeing concentration risk in the core list, at the exchange level, at the S&P level as an index overall, companies aren't really losing their 200 SMAs aggressively. They are, however, losing aggressively their 50 SMAs, and you can see that via the rapid breakdown that we have over here. So this is a possible red flag, and it becomes more of a red flag when and if we start interacting with the 50% mark. Ideally, this finds a higher low above and rebounds up to the 80% mark. That would speak to a stronger rotation from the heavier weight, cap companies here in the core list to a more diversified basket in the S&P. So we're watching this closely to see if it aligns with any rotation in the sectors, right? That would show up in the sectors as well, not just the core list. And then the last indication would, of course, be the RSP, at least specific to the S&P 500. This isn't breaking down aggressively. So if you want like a clear giveaway that you should not be shorting this market aggressively, it's the RSP equal weight staying here basically at equal highs. I could understand if this was aggressively on the lows of the balance, if it was finding price acceptance underneath 155.50, yeah, be my guest to throw a couple of maybe lottery ticket sized shorts on the market looking for these things to come into sync. But because it's sitting on the equal high, I would really not try to step again in front of the moving freight train that we have in the upward direction. And the QQQ equal weight is a great example of that, where the equal weight index actually did break the highs just like the weighted index down below. So that's much more in sync. If we take a look at the Dow Jones, again, this is saying do not step in front of the freight train. It's still divergent, don't get me wrong, but the equal highs and flat highs now right across the top in transports, it's not the prettiest daily bar. It's an inverted hammer there, but at least we have these equal highs now as we're making higher highs in the industrials. So again, if you're skeptical, maybe you just back off on the longs and you think, all right, we'll wait our turn for some sort of more meaningful pullback, but it's certainly not a short based on all of the indications that I can see based on the breadth. Let's move along and talk about volatility. It remains extremely compressed down here, at least in the VIX. People say the VIX is broken. That's cool. We can back it up with the VVIX as well. Historically low reads down here. We're even underneath the sort of healthy, more consolidative zone. So the complacency effect may start to come into view here. If we start to see any strong upticks out of the VVIX, that would be your big first heads up that something is going awry in the S&P, and possibly watch out for a larger downside pullback. Nothing yet, but we're getting very close to that complacency level at 75. So it's a top watch as we move forward here, kind of walking on eggshells. Next up is the volatility futures. Strong contangos continuing to work into contangos. No backwardation, therefore no issues at a futures level for volatility. Apple is up first for the core list of companies, and I want you to be extremely mindful of the potential daily lower high up against the daily 50 SMA, the blue moving average on your screen. In the short term, absolutely, this is an uptrend here. If we take it on down to an hourly time frame chart, you can see that we have lows from the gap down on earnings, recovered with consolidation inside of the two-day balance here. We finally took out those two equal highs a little bit more meaningfully on Tuesday, and then we had another two equal highs breakout, technically via the gap up this morning. But notice the afternoon consolidation mostly took place underneath that 189.25. Technically, into the close of the session, here's the closing print, right? 189.41 is above 189.25. But if we find like an initial sweep to the downside tomorrow morning, I would think about the daily lower high that we were just describing on the higher time frame chart. Consolidation here, then a failure back down underneath 187.50. That weighs on price to the downside. You have your daily lower high, and as we know, we're gunning for the equal lows, which would be down here at 180.25 over time. The buyers can prove me wrong if they can hold daily consolidation around the 187.50 and then get a break of the balance here, potentially recapturing the daily 50 SMA. As of right now, with that sketchy close around the two previous highs, kind of a patience play early on for the Thursday session. Moving along to Microsoft, beautiful chart on today's session, breaking via the gap up over this squeeze level, moving right to the top of the range and closing above. So our job here is quite simple. Any higher lows or consolidation over 412.50, trading it in the upward direction. Any sort of pullbacks that offer a higher low over 406.30, also very much so in play. There's not technically a gap here because of the upper wick of the Tuesday session, so we don't really have thin structure to repair underneath. I would make the argument that yes, a deeper pullback could ensue if we take out some of these lows closer to 410.75. So maybe use that as a small line in the sand, consolidation above that, beautiful continuation. If we slip it, deeper pullback, but still looking for that daily higher low anywhere above, once again, 406.30 from a squeeze point of view. As you can see here, if this is a pie in the sky double bottom, more price acceptance over 412.50, can't really fight this one as it's moving into blue sky territories. What the sellers really need, if the shorts are going to have their day of reckoning in Microsoft, it's got to be a slip underneath 402.75, turn all of this into overhead supply, deeper pullback can start to unfold. We'll take a look at that when and if it happens, but as of right now, no strong indications of that. Let's move along and take a look at Google. This is one of a laggard, basically, one of the laggards of the list. If it can break out over these three equal highs, I was actually very thrilled with the very minor price volatility into the close. Market on close orders did not send this thing haywire. I'm watching this level very closely on Thursday's session, 145.40. If we can break out over it, we're in the gap overhead from earnings. A couple of minor levels that you might want to be focused on. 147, up to 148.20 technically marks a double gap, right? So watching the bottom end of that gap range and prior resistance here from that intraday session might be interesting, and it's certainly within reaching distance, striking distance on a singular day's move for Google. So 147, if we can break the three equal highs and get some sort of bull flag breakout to continue in the upward direction. As we start walking through these as well, think about the number of bullish setups versus bearish setups and what that might imply for our QQQ and the S&P. We've already talked about how there's concentration risk. Now just take exactly what we're talking about here from setups and say, all right, it looks like the core list is more bullish, it looks like it's more bearish, and make your assessment from there. As of right now, I would certainly argue a little bit more bullish than bearish. Same thing happening here with Amazon in terms of equal highs potentially setting up a breakout into early Thursday or even, Friday session. If it takes more consolidation over here, this starts to look more like a pie in the sky inverted head and shoulders, holding all of the gain from the earnings gap up, clearance of this 170.25, trade to the earnings high at 172.35, and then above that, there's some room to run into that 176. So giving this the benefit of the doubt, considering we spent all day consolidating over this point here, 169.25, the sort of rejection point, if you will, the opening print of Tuesday's session. Giving buyers the benefit of the doubt here. Moving along, NVIDIA, the one stock to rule them all. Is there anything bearish about this chart? The answer is just simply no. I mean, right now we have all these equal highs breaking out into the close. Our job is very simple on NVIDIA. Looks like we're already attempting a gap up into the close, right? We have the bid-ask spread here at 705.24 by 60, which is definitely over the closing print at 701.23. So it's unstoppable. If you want to step in front of the moving freight train, be my guest, but don't say we didn't tell you so. All right, so these equal highs, as long as we're consolidating over 694, looking for upside. You can't really be a bear on this chart. Daily trend, we have lows, higher lows. Like, let's just go out to the daily chart. Sure, it's gone, you could call this parabolic, where we've gone from this concave look to a convex look, or vice versa, depending on which side of the curve you're looking at. But this consolidation breaking out through the 3-day highs, I can't really see that as a bearish takeaway. We'll change our tone on NVIDIA when and if there's a steeper pullback to something that looks like this, and then there's a lower high. Like, when the time comes, we'll know that the time is coming, or it's just going to be like something that catches everybody off guard, a large red-bodied bar, and so be it. You can't catch them all in trading. If you're in the game for the long run, you don't try to go for these grand slams. You don't try to go for the one-off what-if style trade. You just let the setups come to you. As of right now, the chart looks bullish. There's not much more to say other than that. Metaverse, this one threw me for a loop, I'm not going to lie. As we were headed into this morning's open, I was starting to think that these lower highs and just the continuation of lower lows as well, testing the earnings gap up low, was going to yield just either consolidation for setting up a gap close, maybe not all the way, but at least a partial gap. And this morning we clearly rallied, so totally on me. That one was a bit unexpected. This consolidation over the highs sets up an hourly, like intraday bull flag, obviously. And if we can break an higher low over 473.50, as long as you can manage your risk up against that level, might be worth a stab to the all-time high. But just keep in mind, buying things at the highest high, buying things at the all-time high, generally speaking, risk reward is tough. So as long as this can remain as some sort of inverted head and shoulders, as long as there's a break and there's some sort of higher low to manage your risk against with a stop underneath this potential level here at 473.50, not technically the worst idea in the world. Really insane relative strength on today's session, ripping to the upside there out of seemingly a bearish pattern, right? These consecutive lower highs paired with lower lows. Next up, let's talk about Tesla. Because the baton was passed. There's your Tuesday performance, strong day in the upward direction. And today, nice consolidation. It was a gap up technically, and I'm not thrilled with the way the gap closed. I would have loved to see a clean gap fill reversal. Market didn't really give us that to the T, but you'll notice all of the afternoon consolidation is above that 185.50 level, which is very historic out of Tesla ever since earnings. You can see a little bit of a squabble. There's a neckline of a possible double bottom. You can see it's where we opened, support, resistance, right? Resistance, so on and so forth. So as long as the consolidation remains above, you're really looking for this short-term hourly trend to continue higher via higher lows that maintain above 185.50 or just continuation into the top of the range. I would be cautious up here and not try to long it at the top and instead wait more patiently for a break and then a higher low above. You want the confirmation above because we've already seen a failed move up and over the earnings gap down high at 192.92. So exercise a little bit of patience out of Tesla. Last but certainly not least is Netflix, and then we'll move into those additional 4 trade ideas for you. Netflix is just consolidation. There's nothing to write home about in Netflix here if we're in this box. Keep it simple in Netflix. No need to overcomplicate it. Longs on higher lows over 569. We need the proof because of the failed move on the Monday session. And shorts underneath 558.25. We need the proof because of the failed move below on the Tuesday session. With that said, we'll jump into the core list. Sorry, not the core list, but the ideas. First one is on MCD. Mickey D's, what do they have for us? Let's go on out to a daily time frame chart. Look at the head and shoulders, right? Here's your right shoulder. Here's your head. Here's your right shoulder. I said that backwards. Here's the left shoulder, obviously. And there's your neckline. Notice on today's session, even though the market's breaking to new all-time highs, earnings are in the rearview mirror, by the way. 2 upper wicks rejecting the bottom of the right shoulder, the neckline of the head and shoulders, as well as the daily 50 SMA, the blue moving average on your screen. If we can start to take out 283 in the downward direction, we have overhead supply weighing on price, a thin structure rally to retest this level at 269. Doesn't have to happen in one day, doesn't have to happen in 2 days, but overall the idea is shorts are more favorable underneath 283 inside of McDonald's. If we can recapture 290.25, we'll change our tone, or at least we will not be looking for shorts to the same degree we are as of right now, given the market structure. Next up, we have Snowflake. What's going on with Snow? It's sort of a reinforcing the idea that's already in play. You'll notice we have these highs, which are acting as support now, and equal highs, I wouldn't say waiting to break out, but certainly looking constructive for a move in the upward direction. Let's drop it on down to the hourly time frame chart to get a little bit more granular here. What I like about this is on the Monday session, you'll notice that we failed the Friday consolidation, and then on Tuesday, we also broke down underneath. Today, we firmly recaptured, and we are getting price acceptance above that 216.65. So as long as that continues, we are looking for equal high breakouts. We are looking to trade this in the upward direction. Do we have a target on the weekly chart? Because remember, it's really the weekly base that we're most interested in Snowflake. Look at this thing here on the weekly, just an absolute monster, right? But to actually get involved on the daily, to target that 240, we're looking for that hold over 216.65 that we were just talking about, and the equal highs to break out, giving us some sort of weekly 3-bar play triggering in the upward direction. Let's drop it back on down to a daily time frame, and we'll finish up these ideas with ROKU. Up next, ROKU is a lower tier tech stock, but I can't ignore the inverted head and shoulders on the daily time frame, right? Look at this left shoulder, look at this right shoulder, flat top right across the neckline, and a gap to close overhead as a potential target very close to 100, the psychological level. So watching 95.50 as a possible breakout point, we don't have the most convincing bar today. It's an indecisive doji, but if we do take it on down to the hourly, there's probably an additional level we can add here. If we can hold up over this 92.90, I would argue, let's go round numbers only up here in the penthouse. If we can hold up outside of this balance, so any higher lows happening here, I would maintain the bullish stance on ROKU for that daily inverted head and shoulders to break out up and over the 95.50. Again, $100 is the psychological target. The gap is technically $100.20, closes 80 cents higher at 101. Last but certainly not least is Shopify, SHOP. What's going on with Shopify? You can see a strong break. You can see that earnings are next week, so we don't have to worry about that just yet. The idea, any higher lows up and over 83.40, looking looking to trade this in the upward direction. Possible upper targets coming from the weekly time frame chart, 92.75, and then way up there at $100.75. Once again, the argument is not that we go here, not that we go here over the span of an hour, a day, even 2 days, but trying to trade this breakout in the upward direction because there is structural room to run overhead. Let's drop it on down to the hourly and just take a look. You can see resistance, 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 resistance. As long as this can act as newfound support on any higher lows or just straight up continuation in the first place, we're trying to trade shop in the upward direction. That's all I've got for you in today's episode of the Midweek Market Update. If you enjoyed the video or learned anything new, let me know down below in the comment section or by giving the video a very simple thumbs up. We'll see you tomorrow morning for coffee and donuts up in the penthouse. We will watch the initial jobless claims come out. And with that said, I wish you a green trading week.